Happy 4th of July. Be safe out there. Remember, those fireworks do in fact explode, and you can, or you don't want to, lose any digits, particularly on a fun holiday like the 4th of July. On this week's program, we're going to talk about the growing trend that we see among employers offering to ultimately take a lump sum instead of a income stream over time. That's something that we're seeing more and more employers do. Plus, over the past couple of weeks, 36 million American households got a letter from the IRS. We've got one of our very own certified financial fiduciaries from Nelson Financial Planning joining us in the next couple of segments to talk about what that letter is, who's eligible for the money that the IRS is talking about, and when you might see it. It can be up to an extra $600 a month getting deposited into your checking account. Isn't that amazing? Anyway, 36 million Americans got the letter. We're going to tell you what it all means and whether you should be taking advantage of that. All that on this week's program. Of course, the program, Dollars and Cents, where we help you make sense out of all of life decisions involving your dollars. We're Central Florida's longest running radio program. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you check us out on your favorite podcast channel of choice. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. So last week on the program, we were talking about some of the questions that you should be asking yourself as you approach age 60, right? Age 60, starting to get 5 to 6 to 7 years out from retirement. And the reality is, if you're getting closer, then your margin of error winds up being reduced dramatically. So certainly some questions to start asking yourself. And really, at the end of the day, they are good questions to ask no matter what. So we're not going to repeat all of them because we got about halfway through them on last week's program. If you want to hear them in greater detail, be sure to check out our podcast from last week. But just to recap, some of the ones that we did talk about last week, we got about 3 that we're going to add into the list for this week. The big ones that we were talking about were things like, do I have enough saved? Is it in the right stuff? Obviously, both of those are pretty important questions. And then what should, in fact, that mix be? That mix between stock and bonds. How ultimately is that mix going to work for you? Do you know your Social Security benefit? Obviously, that's a pretty significant one. And then have you planned for your insurance costs? A lot of people think, oh, I'll just go on Medicare and that'll be that. The reality is that there is a lot more to the cost of healthcare than just that. So those were the things that we sort of talked about last week. Do I have enough saved up? Do I have the right mix? Is it in the right stuff? And my Social Security, my health insurance. So to that, we're going to add 3 more. So 5 last week, 3 this week, and you'll have a pretty good list of the types of questions that you should be asking yourself, particularly at 60, but really at any age is always a good idea. So the next question you should be asking yourself when it comes to taking a look at your finances and your financial picture, simply put, what's the tax implications of all of this? Because here's the thing. When you're working, you have a paycheck through your employer, right? And they take care of the tax withholding. You don't really see it. There's nothing really more that you have to do. Your employer takes care of it, and away it goes to the IRS. Well, guess what? In retirement, that is a little different, right? You've got to make sure that that's being taken care of. So whether that's tax withholding from your Social Security, whether that is tax withholding from pensions, whether that's tax withholding from required minimum distributions, whatever it is, you have to set that up. And it's important to make sure that you set that number up accurately, right? I mean, if you don't withhold enough, then you're going to wind up having to have an extra amount of taxes that you have to pay come April 15th. Similarly, you don't necessarily want to overpay it, right, and get a big giant refund. So one of the things that we encourage folks to do, particularly as they step into retirement, is to make sure that they are getting a complete and thorough review of what their tax projection would be, because it's going to be very different, particularly if you look sort of at the first full year in retirement. That's going to look very different than your traditional work return that had your paycheck income on it. So important to take the time and get a very specific projection on that to have a better idea on what the taxes will be. Next up is the question of, what should my estate plan look like? Yes, as you get older, you're getting older, which means that your likelihood of passing away also increases, right? That's the harsh reality of this thing called life, is the older you get, the less time you got. And so one of the things that we see is that folks sort of understand what they need to do, but then they really don't know how to fully implement it. And when we talk about that, oftentimes folks will go to a legal professional and go through the process of setting up a will, maybe setting up a trust, going through all of these documents. And that part is certainly important, don't get me wrong, because you want to have those documents in place. But then the next thing that you've got to do is that you've really got to take a moment and make sure that that harmonizes with how all of your assets and all of your accounts are registered, right? Because if you've got an account that doesn't have a beneficiary on it, then that's going to go through probate. If you've got an account that names a beneficiary different than what you've set up in your will or your trust or what have you, then again, that whoever you've named as beneficiary is going to be who winds up getting the money out of that account. So it's important to make sure that you take a moment and make sure that everything sort of is harmonized, because all too often people walk into our office and be like, oh, I got this great binder of legal documents, but if you haven't taken the moment to look at all of the different assets that you have, and by that I mean not just your investment accounts or your retirement accounts, but think about your real estate, think about your bank accounts, think about your savings account. All of those need to be harmonized with exactly what the documents are that you've created to implement your estate plan. So if you're leaving it to 3 people, make sure that those 3 people are all named on all of those different accounts. And it's got to be looked at across the board in terms of the different types of accounts that you're naming and listing these people on. And then lastly, one of the things that we encourage people to think about doing is to try and maybe get it in writing. Now, here's where we kind of differ a little bit from most. And oftentimes we see these reports that folks get, and they're like 50 pages of like cookie cutter, computer generated stuff that at the end of the day, it doesn't really tell you anything except a bunch of charts, graphs, and things like that. That oftentimes people are left like wondering, well, what is all of this telling me anyway? And so one of the things that we encourage people to do, and it's an exercise that we certainly do with folks from time to time as well, is to really think about your life much like every business in America thinks about it. And what that means is that we start with preparing 2 documents, a balance sheet and an income statement. A balance sheet, right, that's going to list your assets, your liabilities. Your income statement, that's going to be your income coming in, your expenses going out, and then hopefully it's a positive number at the end of the day. The reason that you do it that way, rather than some 50-page computer-generated cookie-cutter report, is because you really want something that you can work with. You really want something that, for lack of a better expression, you can put on the fridge and ultimately really take a look at it and adjust that over time. So those are certainly some of the things to be thinking about, questions to be asking yourself. particularly as you approach 60, but really for any age whatsoever. So we're going to take a break. We come back. We're going to have Kristen Cayley of our office on to talk about the letter that everybody, or 36 million households, just got from the IRS. So starting in 9 days from today, 36 million families are going to start to be getting monthly checks from the IRS. If you've got 2 kids under the age of 6, that can be as much as $600 per month getting direct deposited into your bank account between now and the end of the year. We've got one of our certified financial fiduciaries, Kristen Cayley, on our team at Nelson Financial Planning, joining us for this segment. She's going to talk about who's eligible, what it's all about, and how it all works, coming up here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you check us out there. My name, of course, is Joel Garris, certified financial planner, certified financial fiduciary with Nelson Financial Planning. So we welcome one of our certified financial fiduciaries on the team at Nelson Financial Planning here, Kristen Cayley. Tell us a little bit about your background. How'd you come to join us?
Yes, thank you, Joel. So I actually interned with Nelson Financial Planning when I was an undergrad at UCF. And then I went off to University of Florida, got my master's in tax, went and worked in public accounting for a few years, and then just came back about 3 years ago.
That's very cool. Yeah, once again, another intern. We got a big feeder system from our intern program here, right? We've got Chet, who just joined us, was an intern. Garrett was an intern, and then Christina, who's been with us for a long time, was also an intern. So we're like half the team. So if you're an employer out there, don't forget those folks out at UCF and surrounding colleges. They are ready to come work for you, and they may very well be a very valuable addition to the team. So what's this all about with these checks that people are going to be getting in a little over a week?
All right, so let's backtrack a little bit and just explain what the child tax credit is and how you've seen it before. So you've seen it before as an annual credit on your tax return, and it was limited to $2,000 for children under the age of 17. So that meant once your kid turned 16, that was the last year that you could get this $2,000 credit. And then up until now, it has been partially refundable, which means that about $1,400 you could receive as a refund if you had no tax liability. So if you had a $0 tax liability, $600 you would not get a benefit for, but you could receive a refund of up to $1,400.
Like a check in the mail. Regardless of whether you owe taxes or not, hey, this money was coming to you.
Exactly.
Okay, so good, powerful tax credit.
Yes, a lot of families took advantage of it, but they've recently expanded it under President Biden and the American Rescue Plan, which passed in March. For starters, this bill keeps the $2,000 tax credit in place, but expands it to $3,600 credit for children under the age of 6 and $3,000 for children under the age of 18. So that means your kid that's now 17 can get this credit, whereas before it was just limited to kids under the age of 16. And then it is fully refundable. So before, when you were limited to that $1,400 refund, you can now get the full refund of $3,600 or $3,000.
So much greater, much more money. And I guess it also depends upon the age of the kid, right? You get a little bit more for younger kids versus older kids, I guess, right?
Yes. So the credit is now $3,600 for kids under the age of 6 and $3,000 for kids under the age of 18.
So who's eligible for this, right? Like you got 36 million households that got this letter. How do they determine eligibility? And I think there's a difference in the eligibility versus this new enhanced credit versus the regular old child tax credit. So maybe talk about who's eligible for this new one, and then we can talk about the old one.
Right. So the enhanced child tax credit is limited to families with $75,000 of adjusted gross income for single filers, and it's $150 for married couples and $112,500 for head of household. It's a little bit different income parameters from the regular child tax credit, which was $200 for single filers and $400,000 for married filers. So definitely a jump there in the income parameters. And then also keep in mind that this new income limit is only for the enhanced portion of the child tax credit. So if you were previously getting the child tax credit, you're still going to get that same $2,000 benefit. The enhanced portion is the portion that has those new income parameters.
So then the letter talks about basically generating out a check that's going to get deposited as early as July the 15th. So that's like 9 days away from today. What do folks have? Do they have to do anything, or how is that going to be determined based upon how much they're ultimately going to get?
Right. So the IRS is going to look at your 2020 tax return and then determine if you're eligible. So if your income has shifted from 2020 to 2021, you may want to take a closer look and see if you really want to claim this credit in advance, because there is a repayment requirement. So if you fall over those income thresholds that we just talked about, you're going to be required to pay that back on your 2020 tax return or 2021 tax return.
And that could certainly be a real surprise, right? I mean, if you're used to preparing your tax return and having a particular result, then the reality is that you could certainly have a big shift on your tax return. So what are some of the things that we might encourage folks to be thinking about when they're thinking about this credit and this letter that they got from the IRS?
So I'd really encourage you to just take a look at your 2021 income so far, just see where you're at in comparison to those income parameters. Again, it was $75,000 for single filers and $150,000 for married filers. And if you think you're going to get maybe a big bonus at the end of the year that pushes you over those limits, just maybe consider opting out, because you're still going to get the credit if you're eligible. It's just a difference between getting it in monthly payments or waiting till you file your tax return.
You know, this is really a pretty unique concept that's getting introduced by the folks in Washington. I mean, I don't think there's any other tax provision that provides for a monthly check like they're considering doing. And my understanding is it's not just this year that they're thinking about doing it, but it's potentially for a number of years going forward. Because we were talking about this yesterday, I just don't think there's anything else like that where you're getting literally a monthly check getting deposited into your checking account.
Nope. It's certainly some different legislation. But again, all of it was part of these COVID-19 stimulus packages. So the whole point is to put money into the hands of Americans, and this is a good way to get families back, into the workforce. And that's how the Biden administration sees it.
Yeah, it's kind of interesting, how the timing of all of this, and obviously on this program we steer away from politics, but or at least try to. The reality is that the higher unemployment amount ends in September, and then all of this starts in July. So it's one of those things where, if you're eligible for this, you're still going to get some money coming in, and maybe the higher amount of the unemployment disappears, but you're still winding up getting money in. So that's an important point, that this is all part of the COVID regulations. I guess they're using sort of the same system that they did with the stimulus checks, right? I mean, same kind of parameters.
Mm-hmm. Same type of concept, looking at your prior year tax returns to determine if you're eligible. And then the major difference between this and the stimulus checks is there is a repayment requirement.
That's pretty significant.
Yes.
That's a pretty significant difference, because the stimulus checks, it didn't matter. Once you got it in your hot little hands, you could keep it no matter what. But this is not the case for this one, is it?
No. You could be on the hook for a pretty big tax bill if you fall over those income thresholds.
Some interesting stuff. Well, can you join us for the next segment as well? Because we got much more to talk about on this. So we'll do that. We'll take a break. When we come back, we will continue on the conversation with Kristen Cayley of our office at Nelson Financial Planning, along with me, Joel Garris, host of Dollars and Cents. So we're talking about the checks that 36 million American families are going to start to be getting in just 9 days. We're joined on the program this week with one of my associates at Nelson Financial Planning, Kristen Cayley, who is a certified financial fiduciary and also a CPA. So she does a lot of the tax prep work around the office, along with projecting what taxes might be. Earlier in the program, we were talking about some of the things that you need to start to be thinking about, particularly when you get to 60. You've certainly run a number of tax projections for people that are looking to retire to figure out what the right numbers are, right?
Yes.
It's important to do that because people kind of forget that your Social Security can be taxable based upon other income. So that can often be a surprise when we're trying to kind of project out the taxes that someone's going to owe in retirement, isn't it?
Mm-hmm. Yes, that in connection with all the other income items, it's really different per person. So just figuring that out before is definitely a good idea.
It is indeed, much like this, right? So we're talking about the enhanced child tax credit that is part of the COVID bills, as we were talking about earlier, that's going to basically put money in everybody's pocket. And just to recap for our listeners, what income levels make me eligible for this? Because this is important, because if those change, you've got some pretty big repercussions on what the impact could potentially be for you.
Right. So the enhanced child tax credit is limited to families with $75,000 for single filers, and that's your adjusted gross income, and $150,000 for married couples. For head of household, it's $112,500. And
so are those hard lines, or is there some sort of a phase out above that, or kind of how does that work?
There is a phase out, so the credit fully phases out for single filers with income over $95,000 and for married couples with income over $170,000.
Okay, so then once you're above that, that's it.
Right.
So then if you're having a better year than you did in 2020, then you need to be careful about taking this money.
Yes, I definitely consider opting out, just reviewing what your income's been so far, what you think it's going to be for the rest of the year, and really take a close look at that and consider the opt-out option.
So one of the ways in which they're determining who gets these letters and who's going to start to get these checks is by looking at that 2020 tax return. Well, what if somebody hasn't filed a tax return? Maybe they haven't filed it because they said, I don't need to, or maybe they just haven't gotten around to it yet. What's the process for those folks?
So the IRS has a website, dedicated to this new child tax credit, and there is a non-filers tool. So if you don't file a tax return, you can just visit that website, put in your information, you can start getting this enhanced child tax credit just the same as those that would file a tax return.
So then the important thing to kind of remember is to make sure that folks understand that as opposed to the stimulus check had no implications whatsoever on your tax return. But this will, and if you're all of a sudden not eligible for it, you're going to have to pay it back. I mean, there's no question on that. The other key change that we talked about a little bit is that the age has also changed. Picks up 17-year-olds, while before these child tax credits didn't pick up the kids of those age. So some pretty interesting things. There's a second letter that's going to be coming out soon. Is that right?
Yes.
And that's going to talk a little bit more about the specifics of how much people are going to get, and then all of a sudden it's just going to start to show up in the bank, right?
That's what it seems like.
The problem is that was not exactly the smoothest process as it relates to the stimulus checks. We still have a lot of folks out there, millions of Americans still out there, trying to figure out where their stimulus checks are, along with many folks who tried to claim the stimulus check back on the tax return, and their tax return is being held up for processing. So a lot more that needs to be worked through on that, but just be aware that if you're eligible for it, if they don't get the check, how's that work? Just put it on they would be able to reclaim that though on the 2021 tax return.
Right. So I would recommend going to the IRS website and seeing if you can, get some information from there, create an account with the IRS, and just take a look at what's up on that website. But yeah, if you don't receive it between July and December, you will get the full credit on your 2021 tax return if you're eligible.
So you don't lose it, but it certainly would be nice to kind of have it coming in on a regular basis. So some pretty interesting stuff, some fascinating stuff. This was, I think, one of those things that when it passed in the legislation back in March, they talked about it, but I don't think that folks really appreciated how they were going to treat it. This notion of sending out checks on a monthly basis is really just pretty unique approach.
Right, and there really wasn't much time between when people started receiving these letters and when these checks are going to come out. It's about a month-long period, and then these checks are going to start being issued.
Yeah, we had folks sending us copies of the letters that they got, and then all of a sudden, in the space of a few days, you're going to start to wind up getting some money in on a regular basis. So some interesting stuff. Very different approach, and also very different tax implications as well in terms of how that's going to play out, particularly if you wind up not being eligible for it, then you're on the hook for it. And I think that's the biggest thing that people need to be thinking about. Perhaps one way to kind of do the analysis, because I know unless you're a CPA, you're not going to sit down and really play with your tax return all that much. Maybe one easy way to do it for folks is to just look at that 2020 tax return and see if they got a refund or see if they owed, right? I mean, that would be the kind of things that you would want to be looking at. If you got a refund, probably fine to get this monthly check. Certainly if you owed, you probably want to not take it.
Right.
Because if you owed, then this credit would wind up at least being available to you at tax time to be able to cover that potential bill. So certainly some interesting stuff, and the current administration is going to potentially look at doing this over the course of the next several years. So this is not a new, or it is a new issue, but it is an issue that will certainly be with us for a few years going forward. So some interesting stuff. Hey, 4th of July, maybe people start seeing more money in their checking accounts, and I guess won't be buying fireworks because we'll be past the 4th, but you can buy fireworks for Labor Day. But what are you doing for the 4th anyway?
I'm actually going to go over to Port Orange and visit my in-laws.
Okay.
So it's by Daytona Beach. So.
Getting credit with the in-laws
Yes.
on the holiday. All right, that's good stuff indeed. I will probably be beach bound and see some fireworks over there. Back when I was younger, I used to light off a bunch of them. I probably will not do that, although I might change my mind as the day gets closer. Certainly there's all kinds of tents and stuff like that available to pick them up at any location. So anyway, bottom line, be safe out there. We're going to slide to a little bit of a break here. When we come back from the break, we want to talk about the growing trend of employers looking to minimize their future liabilities, but by offering employees, or particularly past employees, lump sums in lieu of income streams that would typically be due them for a pension. So we'll talk about that topic coming up next here on Dollars and Cents. Kristen, thanks for joining us today on the program. We enjoyed having a little company in the studio here.
Yes, thanks, Joel. Thanks for having me.
Very good, very good. Coming up next on Dollars and Cents, pension, lump sum versus income stream. We'll talk about that next here on the program. So there's a growing trend out there among employers looking to minimize their future liabilities, particularly in an era of low interest rates. And what they're doing, where they can borrow, kind of cheap money, and they're offering folks to take a lump sum in lieu of a monthly pension check. So one of the ways that we see this concept getting applied to is a wide range of companies. Disney, for example, has engaged in this from time to time. offering folks a lump sum instead of a pension payout. The state of Florida certainly offers that in terms of its option for the investment plan over the pension plan. So we're going to talk about sort of some of the pros and cons of what you need to be thinking about if you are given that opportunity, because there's certainly a variety of things to be thinking about. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning. We're our team of certified financial fiduciaries like Kristen Cayley, who is visiting us in the past 2 segments, talking about the checks that are coming to your bank account if you're one of the 36 million American families that are eligible for that, where our team stands ready to help you in whatever financial matter you need assistance with. So the first thing, before you can get to sort of the pros and cons of how a pension payout of a lump sum versus an income stream, before you can get to sort of the pros and cons on that, there's an important exercise that you have to do beforehand, and that is to run the numbers, right? You have to make sure, right? You're given a mathematical option. You can either take income per month for the rest of your life, or you can get a lump sum today. So the very first thing you got to do before you even kind of get into the pros and cons of, well, is this the right thing for me to do? Is it the wrong thing for me to do? Is you've really got to run the numbers. So here's baseline kind of how it works. So you take your monthly amount and you multiply that by 12. That obviously becomes the annual amount that you're going to get. And then you want to compare that to the lump sum amount that's being offered, and then calculate what the rate of return would be on that lump sum of money to sort of match or keep up with what you would get in terms of the monthly income. So that sounded like a very convoluted math exercise. Let me put some real numbers to it just so you can kind of appreciate. So let's say your monthly benefit that you're being offered is $1,000. So $1,000 times 12, that's $12,000 a year. In lieu of that, right, you're being offered a lump sum of $250,000. So you've got a monthly income amount of $1,000 a month versus a lump sum of $250,000. Do the math that we previously described. 1,000 times 12, that's 12,000. 12,000 divided by 250,000, that's about 4.8%. So that means that the 250,000 would need to be generating about 4.8%, and then that would effectively match what you would be getting from the pension. So those numbers at 4.8, average annual return on the market 7 to 8%. Okay, 4.8%. Yeah, that could probably work for me to really consider the lump sum. Flip the numbers around. So let's use that same example. Your monthly income is $1,000 a month. That's $12,000 annually. But the lump sum that they've offered you is only $150,000. Okay, let's go back, do that math. $12,000 into $250,000, into $150,000 means that effectively that $150,000 would need to make about 8% in order to generate that same level of income. So you can kind of see, before you can really kind of get to the pros and cons of what makes sense and what doesn't, if you're offered a lump sum in lieu of a pension income stream, is you got to run the math first and just see, okay, well, what's the bogey, what's the target that lump sum would need to ultimately generate to basically cover the same level of income that I would be getting. The higher that number is, the higher that lump sum has to perform, the more the analysis starts to tilt in favor of just simply collecting that monthly income, because if the lump sum is being asked to generate 10% or more, then that's a number that starts to get much higher than what you can sort of reasonably assume in terms of the rate of return. So bottom line, if you're confronted with this kind of decision, the first part of it is you've got to start with the math. You've got to start with the numbers. So that's the very first thing that you have to do. And then you kind of get to, okay, what are the pros and cons? So here we go. When does the cash make some sense? Well, the biggest area where taking a cash lump sum amount may make some sense is if the employer's finances are weak, right? That's a big one, right? So if there's some problem with funding or being able to fund, then you may want to think about, okay, well, maybe I'll take the money and run rather than rely on them to generate out a monthly income. That's particularly important in the public sector, because in the private sector, you've got the Pension Benefit Guaranty Corporation, which basically stands behind the pensions and continues to generate out that monthly income no matter what. We've got a longtime client who retired maybe even 20 years ago now from Kmart. Well, Kmart obviously doesn't really exist anymore, but he's still collecting his pension in the same amount that he was when he originally started. That's thanks to the Pension Benefit Guaranty Corporation. That guarantee does not apply to public sector. So again, got to look at the employer, got to look at who's backing it and how all of that works, because the reality is that the deal can change, particularly if you're in the public sector. Ask anybody who works for the state of Florida. They no longer get a COLA, and they are required to contribute to their own pension plan, investment plan, as they are working. So got to look at the finances and see kind of what's cooking with the employer. And then, look, you've got to have the right risk tolerance, right? You can't be so afraid of the market, because ultimately you've still got to generate a rate of return in order to generate out the monthly income. So if your risk tolerance is, I'm never going to do anything more than a CD, then doing a lump sum cash may not be the better option. You may want to just take the guaranteed income, and that's that. So you've got to be comfortable with the stock market if you're going to be taking a lump sum. Of course, the reality is most pensions have about 2/3 of their assets in the same stock market that we are talking about. So understand where that money comes from and how that works. Next up, you got to avoid the cookie jar. You got to look, it's a lump sum of money. It seems like a lot of money. The temptation is there. Oh, I'm going to grab 10 grand, or I'm going to grab 20 grand, or oh, that boat looks really nice. You've got to really resist that temptation, because it's not a cookie jar. If you treat it as a cookie jar, there's not going to be enough money left in it to generate out effectively what would be that same level of monthly income. So you've really got to know yourself, and whether you've got the ability to ultimately not sort of chip away at it over time. Another example of where you might not, the lump sum may have some attractiveness, is if you wind up not necessarily needing that income now, right? With the lump sum, you can take the lump sum, roll it over, and you don't have to generate out income on that. And then lastly, health, right? That if your health is poor, right, you may want to be considering the lump sum as well. A lot of situations where the pension also makes sense in a lot of respects is sort of the opposite of those things that we just talked about. If you don't have much of a risk tolerance, if you don't trust yourself to not raid the cookie jar, those are the kinds of things where you would lean more towards, okay, I'm going to take the guaranteed income on a monthly basis. So those are certainly some of the things to be thinking about. Pension versus lump sum versus income stream when you're given those opportunities. We're going to wrap it on up and get on out of here. Have a safe and happy 4th of July. This has been Dollars and Cents with your host, Joel Garris of Nelson Financial Planning.